Ladies and gentlemen, imagine waking up on a crisp Monday morning, December 29th, 2025, only to find your investment portfolio looking like a battlefield. Silver, that shiny metal that's been on a tear all year, plummeting 14% in what feels like the blink of an eye, from highs near $84 an ounce down to a gut-wrenching $72. But here's the twist that no one's talking about on the morning news shows. This wasn't just some random market hiccup or panicked sellers dumping their holdings. No, this was something far more calculated, hidden in the shadows of our financial system. It was a forced liquidation, a mechanical takedown triggered by over-leveraged players getting caught in the crosshairs of rising margins and thin holiday trading. And lurking behind it all? A massive $40 billion emergency liquidity injection from the Federal Reserve, quietly pumped into the repo markets to prevent the whole thing from spiraling into chaos. Welcome to Cash Historian, where we peel back the layers of money's hidden past to uncover the truths shaping our wallets today. I'm your guide through the murky waters of global debt, central banking secrets, and those economic paradoxes that keep us all up at night. Today, we're diving deep into the real reason silver crashed that day, and why it exposes cracks in the very foundation of our monetary system. Let's rewind the clock just a bit to understand how we got here. Silver's story isn't new. It's woven into the fabric of American financial history, full of booms, busts, and yes, a fair share of behind-the-scenes maneuvering that smells a lot like conspiracy. Think back to the late 19th century, when silver was more than just a commodity. It was a political battleground. In the U.S., farmers and miners in the West pushed for free silver, arguing that basing our currency on both gold and silver would inflate the money supply and ease their debts. This culminated in the famous 1896 election, where William Jennings Bryan thundered about not crucifying mankind on a cross of gold. But the gold standard won out, backed by East Coast bankers who saw silver as a threat to stability. Fast forward to the early 20th century, and the stage is set for one of the most secretive gatherings in U.S. history. In November 1910, a group of powerful men, senators, bankers, and financiers, slipped away to a secluded resort on Jekyll Island, Georgia, under the guise of a duck hunting trip. They weren't there for sport. They were drafting the blueprint for the Federal Reserve System. Led by Senator Nelson Aldrich, whose daughter was married to John D. Rockefeller, Jr., these insiders hashed out a plan for a central bank that could control the money supply, lend to banks in crises, and, critics argue, consolidate power in the hands of a few elite institutions. The Fed was born in 1913, promising to end financial panics like the one in 1907, but it also opened the door to the kind of leveraged speculation that can crash markets overnight. Now, silver's wild rides didn't stop there. Jump to the 1970s, a time of oil shocks, inflation raging at double digits, and a U.S. dollar weakened after Nixon closed the gold window in 1971. Enter the Hunt brothers, Nelson Bunker and William Herbert Hunt, Texas oil tycoons with a fortune built on black gold, but an eye on silver as a hedge against the crumbling economy. They started quietly accumulating silver in 1973 when it traded around $2 an ounce. By 1979, they'd cornered a massive position, controlling over 200 million ounces through futures contracts and physical stockpiles. Prices skyrocketed from $6 to over $50 by January 1980, an 800% surge that made the Hunts paper billionaires. But was this pure market forces or something more manipulative? The brothers claimed they were just protecting their wealth from inflation, but regulators saw it as a blatant attempt to squeeze the market. Shorts, those betting against silver, were forced to buy at inflated prices to cover, creating a feedback loop of panic buying. Then came the hammer. The Commodity Futures Trading Commission and exchanges like COMEX jacked up margin requirements, forcing the Hunts to post more cash they didn't have. On March 27, 1980, Silver Thursday, the price collapsed from $21 to $10.80 in a single day. The Hunts lost over $1 billion, filed for bankruptcy protection, and were later convicted of conspiring to manipulate the market. It's a classic tale of hubris, but it also highlights how central authorities can change the rules mid-game to protect the system. echoing those Jekyll Island whispers about controlling volatility at all costs. But here's where the cause and effect chain tightens, building that suspense I know you're feeling. As prices paraboliced, the CME Group, the exchange overseeing silver futures, hiked margins not once, but twice in a week, jumping maintenance margins by 13.6% to $22,500 per contract. This wasn't arbitrary. It was a direct response to the volatility, designed to cool speculation. Yet in thin holiday trading, the week between Christmas and New Year's, when Wall Street's big desks are half empty, it acted like a spark in a powder keg. At around 2 a.m. Eastern on December 29th, with most of America asleep and European traders on lunch, the selling started. Overleveraged positions, likely from a major institutional player or cluster of hedge funds, hit their breaking point. Maintenance margins breached, triggering automated liquidations. Cold algorithms dumping contracts into a market with barely any buyers. The price cascaded, $83 to $80, then $78, accelerating as options dealers faced a gamma squeeze. For every dollar drop, they had to sell more to hedge, creating a doom loop. It bottomed at $72.32 before stabilizing, wiping out billions in value. But why didn't it go lower? Why not to $60 or even $50 like in past crashes? That's the mystery at the heart of this story, the one that ties back to those central banking secrets. As the liquidation ripped through the system, it threatened the clearinghouses, like the CME itself, which guarantee trades. If a big player defaults, the house is on the hook, potentially freezing futures markets from oil to treasuries. Alarms blared at the Federal Reserve's overnight desk. Repo rates spiked as banks grew wary of lending, echoing the 2019 repo crisis, but amplified by year-end pressures. Enter the emergency injection. Data from the New York Fed shows they pumped in over $40 billion through repo operations in late December, peaking around $74 billion on the 31st. This wasn't about saving silver. It was about lubricating the financial plumbing to absorb the shock. Without it, we might have seen trading halts, broken contracts, and a broader credit freeze. Critics whisper, this is the Fed's invisible hand at work again, bailing out the reckless while everyday folks foot the bill through inflation. And get this, while COMEX silver tanked to $72 over in Shanghai, prices held firm near $89 an ounce, a staggering $17 premium. China's export curbs, starting January 1, 2026, trapped physical metal there for solar factories and defense needs, proving the crash was a paper illusion, not a real supply glut. The fallout was swift but telling. Retail investors, far from panicking, backed up the truck. Silver ETF inflows spiked that morning, with dealers like JM Bullion reporting record orders. Institutional whales got flushed out, cleansing the market of weak hands. By January 1, 2026, silver had steadied around $72, but the damage exposed deeper paradoxes. How can a commodity essential to our green future crash so violently in one market while soaring in another? It points to the fragility of our debt-fueled system, where central banks print money to paper over cracks. Remember, the Fed's balance sheet ballooned past $9 trillion post-COVID, enabling this leverage. In Canada, the Bank of Canada's similar quantitative easing has inflated Vancouver and Toronto housing bubbles, with mortgage debt topping $2 trillion CAD, mirroring U.S. subprime echoes. Failed fixes? We've seen them before. Post-2008 reforms promised stability, yet here we are with bigger debts and flash crashes. The debt ceiling fights in Congress, like the near miss in 2025, only kick the can, adding trillions while Social Security's trust fund dries up by 2035. Up north, Ottawa's deficit spending on healthcare and infrastructure mirrors this, with provinces like Ontario carrying $400 billion in debt, straining taxpayers from Calgary to Halifax. This silver saga isn't isolated. It's a symptom of an economic paradox where endless money creation props up assets until it doesn't. Global debt hit $315 trillion in 2025, over 330% of GDP, per the Institute of International Finance. In the U.S., household debt climbed to $18 trillion, fueled by credit cards and auto loans, while Canadians grapple with per capita debt levels among the highest in the G7. The conspiracy angle, it's not tinfoil hat stuff, it's historical pattern. From Jekyll Island's secret cabal birthing the Fed to the Hunt brothers' takedown, power concentrates in opaque institutions that intervene when elites falter. Today's $40 billion injection, it's the modern equivalent, ensuring the ocean survives even if a whale dies. But at what cost? Inflation erodes savings, widening the wealth gap. Top 1% in the U.S. now hold more than the middle class combined. As we wrap this up, let's distill it into 3 key takeaways. First, markets aren't always fair. They're rigged by rules that change when the system teeters, as seen from Silver Thursday to this 2025 crash. Second, physical assets like silver reveal truths paper derivatives hide. Follow the Shanghai premium for the real story on scarcity. Third, central bank interventions, while stabilizing short-term, fuel long-term debt bubbles that threaten everyday Americans and Canadians with higher costs and economic fragility. As we wrap this up, let's distill it into 3 key takeaways. First, markets aren't always fair. They're rigged by rules that change when the system teeters, as seen from Silver Thursday to this 2025 crash. Second, physical assets like silver reveal truths paper derivatives hide. Follow the Shanghai premium for the real story on scarcity. Third, central bank interventions, while stabilizing short-term, fuel long-term debt bubbles that threaten everyday Americans and Canadians with higher costs and economic fragility. But here's the warning that should keep you thinking. What if the next crash isn't contained by a $40 billion Band-Aid? What if spiking debts force the Fed or Bank of Canada to choose between runaway inflation or a deep recession, popping housing bubbles from Miami to Montreal? It's an open-ended question. Are we heading for a monetary reset, where silver and gold reclaim their role as true money? If this episode opened your eyes to the hidden forces shaping our finances, hit that like button and share it with a friend who's stacking silver or stressing over their 401k. Subscribe to Cash Historian for more deep dives into money's untold stories, from ancient coin debasements to tomorrow's crypto paradoxes. Turn on notifications so you never miss an upload. Thanks for watching. Stay curious, stay informed, and remember, in the world of cash, history is your best hedge.